Hey everyone, it's Tom Thornton, and today I have a special guest, Julian Brigden of MI2 Partners. He's one of the smartest macro minds out there and someone I rely on a lot to just make sense of the market. So, Julian, thank you for being here. Give me your elevator pitch of who you are, what you look at, and we'll get through what's on your mind in a few minutes.
Thanks, Tom. Great to be here, mate. So look, I mean, MI2 was set up 13 years ago at the behest of a couple of clients of mine when I was on the sales side. And when we set the business up, we always set it up, Tom, with the objective of essentially replicating the decision-making process that occurred within a macro hedge fund. You know, one of the things that we're quite proud of at MI2 is that we're not really interested in just pontificating about the macro for the sake of getting that right. Unless you can make P&L out of this, I don't really care. So the way that we kind of compose things is we have a series of quite a lot now models that we look at that give us some sort of lean or bias. You know, is growth picking up? Is it slowing down? Is inflation picking up? Is it slowing down? That sort of thing. And then we go through a process where we say, okay, well, we think inflation's picking up. Is that priced into the bond market or the equity market or the currency markets? And then you can kind of look at those and you can see whether you think that's the case. And then finally, we sort of look at, positioning and so on and so forth. And the whole idea is to come up with a decent risk reward kind of trade outcome. So we're very much focused, as I said, on the trades. That's led us actually at the end of last year, starting really in sort of November, to start questioning this kind of Goldilocks scenario. And I think that's where we are now, Tom. And I think that's something we should kind of tease out.
Okay. Well, I will also say that if people are interested in getting your service, which I highly recommend, they can find you at.
So you can reach out to support at mi2partners.com. Or you could ping me on X or Twitter, which is at Julian MI2.
Okay. So why don't we do this? We're going to keep these interviews relatively brief. I don't want to take too much people's time, especially yours. So do you want to share your screen?
Yeah, I can share my screen, Tom. So yeah, here you go. So this
Ah,
is sort of,
I love this one.
yeah, and it's just a bit of a fun one. And look, I used to work at a policy think tank called Medley Global Advisors, and we still have lots of sort of friends in that kind of direct to policymakers kind of space. And it's been increasingly clear that the Fed is absolutely desperate to try and achieve this soft landing. And I would almost say that, you know, this is soft landing versus defeating inflation. I'd probably put the soft landing over the inflation, and I'm not necessarily saying they're wrong. There are just consequences. So, but I think there are a couple of things that we need to address because the market has become singularly focused on one metric, Tom, and that is inflation. And we were super bullish on inflation in 2021. The first piece that we wrote on very beginning of January 2021 was inflation, the most important metric of 2021. And we were calling for almost close to double-digit rises. And if you put your head back in 2021, I remember one client, doing that pitch in January of 2021, and the guy saying, "You're insane," right? As it turned out, we were right. And then basically, we flipped that position, and subsequently, we've been looking for inflation to fall. And we're starting to shift again, or we started to shift again at the end of last year, in the sense that we think there's quite a long way to go in terms of defeating inflation. And yet the market has gone singularly all in, I think 100% into this Goldilocks idea. And, let's define what Goldilocks is. Goldilocks is kind of the porridge isn't too hot, it isn't too cold, it's just right. And the question is what is that porridge? Because as I said, I think it goes beyond where we are in terms of just inflation. I think we need to see slower activity. Now, I think there's a couple of things that we need to address. The first one is that the market still does not understand the policy framework that the Fed is pursuing, because this has not been a very typical tightening cycle, and we'll draw attention to that in a second. This has been a very different tightening cycle, and the reason is they're pursuing this policy called opportunistic disinflation. Now, this is something that Alan Greenspan pursued in the mid to late 90s. It is a very, very, very different tightening cycle than, say, Volcker's deliberate disinflation tightening cycle. So if you want to draw an analogy between the two, this was Volcker, right? This is you walk the economy into the back garden, you shove its head underwater, and it drowns. Deliberately dead, killed, no inflation. The second one, Tom, is this opportunistic disinflation. Now, you can see this poor lady on the left-hand side is not, or this poor girl on the left-hand side is not in a comfortable position, but they're clearly not drowning, right? Now,
Right.
how does this manifest itself? Well, it manifests itself, if you look at a typical tightening cycle, with easier rates than you would typically get. So if you look at, say, Fed funds versus nominal GDP, if anyone's interested, I can explain later why, nominal GDP, but take it as is because we've got time constraints. Then in a typical tightening cycle, Fed funds are at least 100 basis points from this bottom of this red band here to 350 basis points higher. Where would that put it? It would basically put Fed funds at close to 7%, right? We are not there, Tom. We are 140 basis points, roughly 150 basis points away from that level, okay? And that is compatible with this period here. This is Greenspan's opportunistic disinflation, okay? There is, however, another outcome, and that's this, 1966, 67, but we'll come back to that in a second, okay? Now, we haven't tightened as much as we would typically do, but then there comes a payoff. And what is that payoff? Higher for longer, okay? And this is what the Fed has done an absolute shitty job explaining, right? You get inklings of what they're thinking from, for example, this speech from Chris Waller, where he said, in many of the previous cycles, which began after a shock to the economy, either threatening or caused a recession, the FOMC cut rates reactively and did so quickly and by large amounts. This cycle, however, with economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as we did in the past. That is precisely that scenario, Tom. Right? Now,
Right.
it doesn't preclude tweaks. Right? So if you look at 95, what Greenspan does is he jacks rates up into 94, your real rates rise, right? Fed funds rise to, 6%. And then there are 3 rate adjustments, July 95, December 95, and Jan 96, for a total of 75 basis points, right? Because you don't want real rates getting too tight and you deliberately drowning the patient, Tom, right?
Right.
But then know what happens. Rates went on hold for 30 months, right? You tweak rates, right? Because you didn't break anything, you didn't jam rates to the point that they killed the patient, you don't have to slash them. You literally just tweak them. Now, one note of caution, as I would say, is that in 95, what aided this was the fact that we had much higher unemployment, right? Almost double where we are now, 7%, and average hourly earnings were only 2.6%. Okay.
So one thing,
But
Julian,
even
that
then,
we've talked about,
only
one thing,
75 basis points of cuts.
so one thing I've had a lot of people talk about, where it's very similar, this period, to the soft landing that the Fed, had in 95,
Correct.
96. And I see a lot of differences. One being $35 trillion in difference with the national debt,
Yep.
and also had the advent of the internet,
Yep.
which you had mom and pop and every company logging on and selling stuff online, emailing, buying computers. And I think that's different than the AI craze today. And you had this tailwind with that, which was a monstrous tailwind in the
Monstrous tailwind.
economy with the markets, and very broad, I will add as well. And then you also had, and maybe it's not appreciated enough, the tailwind with the peace dividend since the Soviet Union was no
Correct.
longer in business.
Yeah, the collapse of the Berlin Wall, uh, and the advent of that peace dividend. So I think there were lots of differences. But look, I will say at face value, Tom, it could be the same. I mean, this is what you're talking about, though. This is what you got in the late 90s. You got this burst of extended productivity,
Hmm.
like 4 to 5 years of steadily rising productivity. Now, that is definitively the Goldilocks scenario. That is your get out of jail free card, your golden ticket. It is absolutely everything that will give us the soft landing because it enables three things, Tom. Very rapid nominal GDP growth on a continuous basis, like 6%, right? 5 to 6%. That is incredibly good for equities because that's what margins are dictated by. Okay. Secondly, falling inflation, right? Great for bonds. And thirdly, falling unemployment. But as I said, you've got to be careful because you were starting at over, go back a little bit further, almost 7%, right? So you had capacity to grow into. Now, is it possible that AI delivers that same productivity burst? And I think ultimately the answer is yes, it will. The question is it this year? Or is it next year or the year after? Right?
One
Because
thing,
if it's not
one thing,
this year,
Julian.
we have a problem this year, Tom.
Well, like, I've been talking about this a little bit, and I have a really smart ex telecom analyst who was right there in the bubble, um, and he really came up with something that was interesting. And he compared NVIDIA and AMD and some of the AI darlings that are seeing massive earnings growth right now to Cisco and Nortel and Ciena and Juniper and these networking companies that were building out the internet in the 90s. And they had huge earnings growth back then,
Yep.
not the market cap expansion as you've seen today with some of the AMDs and NVIDIA, no doubt. But he said that he sees basically that peaking out eventually. And when, I don't know. But
I
he
mean,
said
look,
that,
just for a bit of fun, I can show you, I like what I refer to as chart porn, right?
so while you're
There-
getting chart
There's
porn up,
there's a little
one
bit of
one thing
chart
real
porn,
quick,
Tom. Can you see
one thing
that?
real quick, Julian,
Yeah.
this is something that I think is interesting. He said, what we don't know is what companies are going to be the ones that truly monetize AI.
Correct. Correct.
That's going to be the thing. So I'm sorry to
No,
interrupt you
so
on that.
can you see this? This
Yes,
is
I can.
Cisco versus Nvidia, right?
Yeah. Oh,
You know,
great.
we broke out from this sort of consolidation. You typically in what I call a classic bubble. I mean, this does look literally like a classic bubble, right? And I've looked at every single classic bubble going back to 1929. They tend to have this sort of move up in a relatively logical plane, and they kind of pause and break, and you move into this parabolic move, which we're in now. But this is
Hmm.
not enough yet, right? Cisco was 120% from that kind of consolidation period. This is only 15, and others went even further, right? Others went even further. So
But that last Cisco move was about $100 billion in market, or yeah, about 100, because I think it peaked out at 500 billion Cisco,
right.
and it peaked out at 500 billion. So that's $100 billion more in market cap. And Nvidia tends to, if it goes up 10 points, that's 25,
Yeah, but you got to look at the
25
overall
billion.
size of the market, right? I mean, 100 billion back then was quite a lot of money. Right
Yeah,
now it's chump change. We swing that in a day in single stocks, right?
yeah, it certainly seems that way. It's been that kind of
So,
market.
but I will say, Tom, at face value, right? At
Hmm.
face value, we have Goldilocks, right? We've had falling nominal GDP, but it's still high at 5.8%, right? We've had CPI falling further, so you have had real growth reaccelerating, right? Remember, these two add up to this, right? To nominal GDP.
Right.
So this is Goldilocks, right? But there are two risks that I think you run, Tom. The first one is rather than the porridge staying just right, the porridge can get too cold. And how do you do that? Well, you lose momentum in employment, right? You keep rates too tight for too long, which I don't think is what the Fed is trying to do. They're clearly trying to land that soft landing,
Hmm.
okay? And you lose momentum. And once again, here's a bit of chart fun, but employment is definitively a momentum indicator. Otherwise, you couldn't run a moving average over it, right?
Right.
So 27-month moving average going back to 1950, Tom, right? Not even you are that old, okay? But the point is whenever you have crossed that, and we are sitting right on it, you have always, always, always had a recession.
Is
Absent
this the
one,
Claudia Salm rule?
I mean, it's, Claudius takes too long because you have to wait for the 3-month moving average, blah, 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 right? I don't care, right? I like to
Right.
keep it simple. And there's only one occasion where you didn't have that, Tom. 1966, 67, where you clip it and then employment reaccelerates, okay, to the downside. Unemployment reaccelerates to the downside. But that's your second risk. Because in 1966, 67, Tom, people may hold this up as a soft landing. I think it was a bloody disaster because you had 9 months, maybe a year, actually 6 months in the bond market where the bond market saw a soft landing. So let's just run through this. Oops. So early 60s, no inflation, nirvana, right?
Hmm.
Johnson comes in, spends a lot of money on the Great Society. You could call that Trump's first spending boom in 16, which I think was 16, 17, which I think was right. Or you could say it's, what Biden did during COVID. But government spending accelerates. Fed hikes, okay, quite aggressive, 275 basis points. But unemployment keeps kind of falling. And then they get a 25% stock market correction. They get a mini credit crunch, Tom, and it panics them and they ease almost all the hikes back, right? And what does that mean? You're easing into ongoing solid government spending, okay? And your unemployment never ticks up. Right? It just kind of flatlines for a bit. And then as growth accelerates from the easing, albeit government spending at a lower level, your wages pick up, your CPI picks up, and you have your second big wave of inflation. And I think when I look at things right here, right now, Tom, I think that is the risk. That rather than being Goldilocks just right or too cold, on balance, the risk is that things are too hot. And when things are too hot, Tom, with 3.7% unemployment, unless we have that productivity surge right here, right now, the risk is that your wages will accelerate again or remain sticky. I mean, for goodness sake, Atlanta is over 5% wages, right? And that means that your core service inflation, okay, which correlates incredibly tightly to inflation, incredibly tightly to wages, will not slow down. right, will not slow down. And if the Fed persists with rate cuts, if they're able to squeak them in, and I think there's some political bias to one, as I said, a recession doesn't seem to be an option. There's an institutional fear that I hear of Trump, right? If they decide to pursue rate cuts in that environment, right, they would certainly be far, far less than the market is currently pricing, which is why we've been short fixed income since early December. Okay. But if they do, then the consequences will be enormous. And almost certainly we're looking at another surge of inflation at some point towards the end of this year into 2025. But
One
it's almost
thing,
as though no one
one thing you
gives a shit
mentioned,
about the long-term consequences, Tom. They just are focused on the election.
right? Yeah, I mean, I think I've said I think they've started a little too early with their election market pump. Uh, they may run out of some bullets, and
Remember, Yellen's still got the TGA to deploy, and that's over 800 billion.
yeah, that's I think she's putting it all into super micro and Nvidia today. Uh, but I think that I think you're absolutely right. We do have that risk of running hot, and I also try to balance things and think, well, if unemployment is at 3.7% and we start to see this thing tick up over 4%, God forbid, it'll be just a national emergency. What's the Fed going to do? Are they going to be cognizant of that and do the maintenance cut, as I've heard it called?
Look, I think if they really thought that unemployment was starting to motor, and as I said, it's a momentum game. So you get much above sort of 4.1, you could go from a 4.1 to a 4.5 in a month,
Right.
right? Um,
The thing
but it's
is also,
very finely balanced, Tom, and this is why. And in that situation, they would probably cut quite aggressively. But the point is, mate, this is why this 100% Goldilocks pricing that we have in markets, right? We have almost 100%. Yesterday was the kind of first, with the CPI was one of the first sort of tests of that. Oh, what do you mean inflation's not going down straight to 2% with 3.7% unemployment, right? But when you look at history and you go and you look at all the tightening cycles since 1960, sorry, there've been 12. Okay. There've been 12 tightening cycles, 8 recessions, right? So at face value, Tom, the statistical odds of you landing the triple sulco with the tuck is 33%, right?
mhm.
Statistically 33%. But it's actually, I think, worse than that because, and I'll share the screen again so you guys can see. So here's effective Fed funds, here's recessions, right? So 12 recessions, 12 tightening cycles, 8 recessions. Now, here are your soft landings, 66, 67, which we went through, right? I don't think was a soft landing for like 9 months and then it all went horribly bloody wrong.
Mm-hmm.
Mid 80s, late 80s, 94, 95. Okay. Now, here's the thing. These latter 3 all had significantly higher levels of unemployment, Tom.
Mm-hmm.
And in 95, you got the productivity. So the point is your starting point for the re-acceleration of growth, which is what the equity market is factoring in, occurred with a level of resources availability in terms of unemployed people, which was significantly higher than it is now.
Yeah. So,
Starting point was just much better. So if I look at this, as I said, right here, right now, and while it's delicately balanced and it could shift, you drop the equity market 20% and you hold it there, we've got a recession. It's a given, right? That's a given. Okay. But right here, right now, I think things are too hot. I think the Fed is ludicrous to even be contemplating rate cuts. Okay, but they are. So we have to take that as a given. So that leaves me thinking then at some point the bigger risk is that actually inflation doesn't come anywhere close to the levels that they hope. In fact, the risk is at some point next late this year, early next year, it re-accelerates. And I think we're in a whole world of bloody pain at that point.
So that's something we've talked about numerous times about the unemployment rate at 3.7%, and the starting point at other periods when the Fed has started to cut rates.
Yeah,
And it would be sort of extraordinary to see the Fed cut rates at 3.7 or even at 4%. And even if they do that, and I'm not even going to mention the S&P's at an all-time high,
correct.
that's another extraordinary thing that is just baffles me. But when they when unemployment starts rising, as you mentioned, it is a moving average. It starts
Yep.
to lift and it doesn't stop for, 2 quarters. It goes on for
I mean,
quarters,
I think
years.
the average rise, Tom, is I might be off by a 0.1 or 0.2. It's like 3.6% in the post-war period when it rises. So you are not looking, once unemployment starts to rise, don't expect it to stop at 4.1 or 4.5. Statistically, it's going to 7.
Ouch. I was going to
I
say
mean, people,
5.
I'm sorry, but people just forget. We've got so anesthetized that we have this benign force that comes in and gets our back every single time, right? And they'll never let anything ever get out of whack. What are these, like superhuman beings?
Do you think
I've spent my last 35 years of my career pretty much betting against central banks, right? Because they're
do you think
crap at calling cycles.
So, Julian, do you think that there's going to come a time where I mean, I think right now you and I can agree that the market has supreme confidence in the central banks doing the right thing for the markets, and that's giving them goodies and lowering rates down the road. We've seen rate cut cycles that typically when they start a rate cut cycle, things are just starting to get bad and they get worse. And that includes equity markets, not necessarily bond markets, but the equity market typically sees weakness. And
Yeah.
unemployment at 3.7%, you and I have talked about this in the past where you don't necessarily see a lot of unemployment start with equity markets at highs. You typically see equity markets when they go down, like when we saw in the end of 2022, the equity markets were on their ass, and you saw huge tech layoffs. Meta
Yeah.
laid off a bunch of people, and Mark Zuckerberg, had fake tears saying, "I'm sorry, you're fired," to all of his employees. And then all of a sudden, the stock goes from 100 to 400.
So he's not
Uh,
he's so upset after that.
yeah, he was just like, "I'm so sorry." But hey, listen, I think that's the risk. If we do have an equity pullback, a correction of some sort, and I think it's going to come with those AI darlings. I think next week's NVIDIA report is pivotal to the whole equity market I mean, I just looked at the attribution. NVIDIA is around 37% of the NASDAQ 100 gain so far this year.
Right. Look, I don't disagree with you, but I would say that I'm a macro guy. I love it when I can short equities. Right? There is no better feeling than nailing the equity market because you bunch of the glass is half full equity boys who just buy things and hold them forever. That's deeply, deeply annoying, Tom. Right? So there is nothing more than I want to take that glass and shove it where the sun don't shine. Okay. Intellectually, that's the most fulfilling thing from a macro guy. But the backdrop structurally, I don't think yet is inducive to. I'm not technicals. Look, I understand you. You're 13s and so on and so forth. But I look at this big picture. I have interest rates that are still relatively low compared to nominal GDP. I have, and that's typically you need treasury yields to be like 75 basis points over nominal GDP. So you 10-year treasury yields would have to be 675, right, to really ding the equity market. Okay.
I think if you get to 5% again, it's going to ding the
Yeah,
equity
but
market.
I mean, look, I don't disagree. But then Janet Yellen deployed. If this weren't an election year, Tom, I'd be happy to be much more bearish. But I think they seem determined to want to keep this game going for whatever reason. Fed and Treasury, and Yellen has more control over liquidity than the Fed does at this point. Though I could see a 5% correction, don't mind me wrong, a 10% correction. And then she goes and draws down the TGA. And essentially what that does is fund government spending without taking that liquidity out of markets, which is actually very bullish. And you could get a ripper into the election again. So I think the discipline, once again, which is why we shorted bonds back in December, has to come from the bond market.
Yeah. Listen, a lot of people have always said, the bond market gets it right.
I don't
And
know whether
are
the
they
bond
the ones
market
getting
gets
it
it right,
right?
but I mean, they're certainly, when I look at it, it's not getting it right now. These assumed cuts are they're smoking the good stuff, which you can get up here in Colorado.
Oh, yeah, that's right. Well, I think we can get it here in Connecticut now. I don't know if
I
it's the
think you
good
can,
stuff.
yeah. Yeah.
Yeah, it's not my
Not
thing.
my gig, but
So anyway, so let me ask you this, just to kind of finish up here, and I really appreciate you joining us. I always love chatting with you. You've got a great sense of humor, especially about money and macro markets, because again, it is just money. We're not shooting at anybody and killing
no,
anybody.
no.
Um, are there any places that are on your radar that you would buy right now?
In equities.
Well, anything.
So we're getting quite interested in the dollar. Now I think we wrote this piece at the start of the year where we called fading reflation. So if you remember, we sort of rolled into January and everyone said, okay, now the market broadens out.
Oh
Okay.
yeah, they always do. They always say that in
And
January.
and we said, I don't know, because what really had in Q4 was an everything rally, right? Bonds went up, stocks went up, Russell went up, NASDAQ went up, everything went up, right? And what we said is to kind of broaden this thing out. What you really need is and get sort of value outperforming growth, is you really need weakness in the dollar, right? The dollar is the denominator of kind of global liquidity. And if you get a true reflationary wave, you need to see a weaker dollar. And then you'd expect things like metals to outperform and industrials to outperform and Europe to outperform and emerging markets outperform, et cetera, et cetera. And when I look at things as things stand at the moment, Tom, it's beginning to look to me, and we're doing some work on it at the moment, that actually this is going to be a dollar up year and a euro down year. And I think that to some degree goes and it keeps this equity bubble game going in the US to, I think, horrible ultimate consequences. But, we don't have to get into that right here, right now. And I think actually quashes a lot of this kind of reflationary euphoria that we have. Because the dollar up, presumably on the back of the Fed, maybe not cut the market beginning to realize, oh, wait a second, they're not doing, 200 basis points. Maybe they'll only do 100. Maybe they won't even do that, right? I think will be a bit of an epiphany. So that's one thing I'm watching pretty closely, because I think that's a key metric for broad market sentiment.
Yeah, I've been positioned and biased long the dollar off this low, and it's getting a little high with the sentiment indicators, and you have some DeMark countdowns that are still going higher. And I've been really watching, and we talk about this all the time. We watch the yen, and that seems like that could be a real macro risk.
I mean,
if the Bank
that's
of Japan
merely
loses
really
it.
more a US Treasury yield play than anything else. But you are coming up to some humongous levels. Like 152 in dollar yen is a multi year high low when you look at it. Resistance
Right.
line. So that I think is a very interesting level. I wouldn't be surprised to see some MOF intervention. They talked about the speed. You know, they've always said it's not the level that matters, it's the speed. And we've moved 10 big figures in, 6 weeks or something. So I think they're getting a little nervous. I wouldn't be surprised to see some intervention. And I don't disagree, Tom. Some of the euro move looks a little extended, but the first 2 to 3 months of the year are absolutely pivotal for setting the direction of the dollar. Statistically, very, very high correlation that you break out of the ranges of the first few months of the year, your trend is kind of set one way or the other. And it's beginning to look, as I said, a bit like a euro down year.
So plan trips to Europe. Okay. For us Americans, we're going to make some trips to Europe. Okay, so I'm going to leave it there. And I just want to say thank you very much, Julian, for joining us.
Pleasure, mate.
It's always great. I'm going to have you back on. Especially we can do even a shorter one if there's
Yeah,
something pivotal happening. We'll just get in there and go right to the meat of the matter. So thanks so much, and we will talk soon. Take
pleasure,
care, my
mate.
man.
Have a good one. Bye bye.